All right, well, this is going to be part 3 of the 10K tutorial. Going to wrap up the income statement on this one. Going to try to keep it short, but you know, I always love to ramble, especially about finances and the stock market and accounting, especially. So we'll see how far this goes, but I want to wrap up the income statement, talk about a few important metrics from the income statement because you know, there's a couple things we still didn't cover. First one, we looked at EPS growth. You know, what drives Wall Street, what drives earnings, what are some different ways you can calculate EPS growth. So that was obviously very, very important. Second week, we did, why am I blanking right now? We did dividends. Obviously, dividends are crucial and a part of the income statement as well, and something that you need to learn how to find. So for this last one, I'm going to talk more about like price-based valuations, more specifically price to earnings and price to sales. Show you, you know, they're obviously pretty easy calculations. You should be able to find them quite easily in the income statement, the 10K, but there are some things in there that you probably haven't figured out if you're not familiar with financial statements. And you know, I just couldn't wrap up this part on the income statement without talking about these things. So that's what this video today here is going to do. Now, I mentioned last week on the dividends one, where sometimes the consolidated financial data, the stuff that's audited, is not in this section 1, but sometimes in like a EX13. So here's an example, right? This size is talking about like the size of the file. That's what I'm assuming. You can see this one's higher than this one. So this is the company I was talking about last week. This is Hormel Foods, HRL. And there are a couple other companies that do this as well. I think it's a really old-fashioned thing because it seems to be in these businesses that have been around for like over 100 years or something. I think Hormel fits into that category. But anyway, most every stock will put their audited stuff in this section, but every once in a while you get like a Hormel. So I want to show you that. Here's another thing that's important. When it says selected financial data, that's going to give you data that is not GAAP, which is generally accepted accounting principles, practices. I can't remember what that P stands for, but you know, that's important because if it's not GAAP, then it's not audited by the SEC, and so they can kind of manipulate data and do things of that nature. So you want to always make sure you're looking for consolidated. Now I'm going to do my little trick like I always like to do, where I Control F to search for consolidated. Okay. Well, they called it something else. It's not. Maybe it's condensed. Sometimes that's a thing too. No? How about just balance sheet? So you have to be a little resilient when it comes to this stuff, but that's okay. Okay, it's not on here either. So did they actually put it in the 10K section? I'd be shocked because that'd be different than how they used to. So, I mean, this is a good learning experience because then you can see that it's not always straightforward looking through these 10Ks, and not to get discouraged. Maybe if you get stuck, pull up one of my tutorials and you can see, you know, even though I've been reading through annual reports for a long time, I still get lost, and you just have to know how to poke around. Here we go. There's consolidated. Oh, this is so ugly. This is probably one of the most confusing annual reports I've seen in a while. And that's usually not a good sign. All right, that looks familiar. Here we go. Consolidated statements of financial position. Why they call the balance sheet statement of financial position is beyond me. But, you know, I should have done this. I should have searched for statements of operations because that's pretty common as well. So let me put down the mic here and let's get Excel going and do a couple of these ratios real quick. And then, maybe we might walk away learning a little something from this. So just to review, price to earnings, it's a very basic ratio. It's very important because a low price to earnings will indicate that either a stock is very profitable, it has earnings, or that the stock market or the stock's priced so cheaply that, when you talk about like a below average PE ratio, that means that the market is undervaluing the stock compared to its earnings compared to the average. So better chances at getting into stocks with, if you're looking to be a contrarian, if you're looking to go against the crowd like we are as value investors, then a good chance that, with a low PE, it's one of those indicators that's going to tell you, okay, either we're getting a ton of earnings or the market is not valuing this company's earnings as much as it's valuing the rest of the market's earnings, or a combination of both. So, either case, that's usually a good thing. So let's make a couple metrics here. And it's going to be real simple. Okay. So let's go ahead and fill this out. Hopefully, if you've seen a couple of the previous tutorials, you'll know exactly where to look. But when it comes to the income statement, we're going to look at something like this. And remember, revenue is the same as net sales, which is the top line of an income statement. So, or statement of operations. So that's going to be right here. And they say it right there, boom, net sales. So that's going to give us the number. Something I like to do, I've been doing this recently actually, because I think it's good to see revenue growth. So kind of in the same sense that I was calculating earnings growth, I like to look at top line growth as well. Because it can give you a good picture, So the thing about revenue, which is something you have to talk about whenever you're thinking about net sales and really the income statement in general, is that it can help using a valuation like the price of sales. It's going to be very similar to the price of earnings in the sense that you're going to get either a stock with a lot of revenue or a stock that their revenue isn't being valued by the market as much as the average stock, or again, a combination of both. Now, net sales is arguably more important, and the price to sales ratio is arguably more important than the price to earnings ratio because it's harder to manipulate. And so if you ever look at like a company's income statement, you'll notice that in general, the numbers fluctuate a lot less. They fluctuate a lot less than like the earnings would. There's a lot less volatility. And so because of the way there's like discrepancies on the way earnings can be reported, you can have like special charges, expenses, I think depreciation, amortization. There's a lot of different accounting things that go into how earnings are created. And it's not done intentionally in an intentionally confusing way to make it intentionally confusing, but it's the general nature of running a business. For example, you might have contracts with different manufacturers, and so it's like, okay, well, we're going to have a couple of orders that go through this year, maybe next year. Maybe I need more inventory for fourth quarter, so they might book a sale for fourth quarter, but they won't actually pay the cash out for that in, let's say, quarter one of the following year. So depending on how they're doing the accounting, it could affect earnings. They have things like depreciation, which is talking about, okay, well, if I buy this factory or let's say I buy this piece of machinery that, builds cars from scratch. I don't know. And so let's say the average machine tends to last 10 years. So they'll do an accounting thing called depreciation, where they'll take the value of that piece of machinery and then you will expense it over every year until the life of it's done. And then each year that it goes against that is depreciation. So, there are things like that. And it's all of its purpose is to really give you a good sense of a company's profitability from year to year. It's not always going to be perfect because there's going to be a lot of factors that are in play when it comes to stuff like this, but it's something to keep in mind. And so just the nature of the beast. And yes, you can get discrepancies from year to year when it comes to how they book sales in the same way that, how are they going to book profits? But in general, and historically, we've seen a lot less manipulation in revenue than in earnings. And so it can be quite helpful. And, if you're really interested in looking more into like the price to sales ratio, I really recommend James O'Shaughnessy's What Works on Wall Street. That one has a great breakdown about price to sales ratio. It talks about how combining that with the price to book ratio can give you a lot better investment returns in the sense of going for the type of stocks that have low ratios for both price to sales and price to book compared to like just doing like a straight low price to earnings ratio type of strategy. So I think that can be very, very helpful for people out there too. Let's fill these numbers out. I'm just going to convert this into millions. So if you're wondering why I'm ignoring the last three, that's going to be why. It's just going to make it simpler. So let's go ahead and put this stuff in. And from what I can see, looks like let's calculate that growth. Looks like a decline of it looks like it declined. All right, and then let's do earnings. Remember, that's going to be net earnings here. It's the bottom line. And so you can see they do like net earnings attributed to Hormel Foods and then regular net earnings. It's really strange, right? Because sometimes they'll just show you net earnings straight up, and sometimes they'll do this attributable thing. So, in this case, we're going to look at the bottom line, and we're going to use that. So that's going to be this, and it'll be 846. Let's add some decimals just so we're more accurate. So, it looked like, perhaps unsurprisingly, that the same year that revenue declined, the earnings declined as well. I don't think that should be too shocking. So margins probably didn't change all that much. Here's that big fluctuation I was telling you about. So people like the revenue, net sales. They like that stuff because it can be a good kind of indicator of how demand's doing for the products. Because again, like, think about it from a business standpoint. It's a lot easier to cut costs than it is to create demand for your products to attract more clients and all those sorts of things. You get the kind of the stereotype of the big corporations who will find any little way to cut 2 pennies off of a cost and multiply that in scale. And so you'll tend to see that. And here's like an example of that where they were able to change something with some of their costs, whether that was part of operations, whether it came somewhere else, whether it had to do with taxes. Who really knows? And I'm sure we could dig in deeper to the report to find out something like that. But just in the sense you can see how if you were really evaluating, oh, well, I see 30% growth here, but you're not taking the fact that there's only 3% revenue growth into consideration, you might not be getting the whole picture. And that's not always the case, because sometimes over the life of a stock, a company can just get more and more efficient. That's like increasing their return on equity. But revenue growth is usually tied to sales growth, and you want to see both of those going up. Don't have to be a perfect one-to-one thing, but you're generally going to want to see that. So, I mean, if you think about it too, 30% growth when this is only growing 3%, that's not going to be sustainable. It's eventually going to run its course. So, just something to keep in mind. I like to do that when I'm seeing, I think it just gives more context. So here we're going to do shares outstanding, because this is going to give us the market cap calculation. And from there, we can calculate price to sales and price to earnings. So shares outstanding is going to be, let's just do the current year. So remember, we're doing diluted. If you don't know why, watch one of the previous tutorials where I explain that. And let's take the stock price that it is right now, 35.37. And so if you're an absolute beginner, the market capitalization is just simply the share price multiplied by shares outstanding. It's like the total value of the stock in the marketplace. So you can see it's at about 19 billion. Google Finance is telling us 18 billion, and that's probably because they're not considering diluted. Yeah, see, they go 18.7, 18.6 if I'm rounding. So that's why you'll see a difference. All right. So price to sales, pretty simple. Let's do price to earnings first. That's just going to be your market cap divided by the earnings. You can see it's quite simple. Remember, price to earnings just means price divided by earnings. The market cap is the price of the total stock. Shares outstanding is included in market cap because you're making sure you're including the total price over the entire market. And then you're looking at total earnings. And so that's how you'll get the price to earnings ratio. I guess, let's not look at it over many years, because that's not really helpful today. And price to sales, you can do it the exact same way. You'll take the market cap and you'll divide it by the sales. And so in general, you'll see a range. Usually, if it's below 1, that's really, really good. Sometimes it can get up to like 5 or 10. Generally, I like anything under 3. Sometimes, depending on the stocks, other financials, I might consider like a price to sales around 4. But at 2 and the PE of 22, those are not bad, especially considering that the Schiller PE right now, I believe, is like coming on close to 30. Yeah, we're looking at a 31. So a good PE in relation to the overall market. Now, one last thing I wanted everybody to know about income statement is what can be helpful to gain further understanding on what's going on with the income statement is to look at the footnotes. And I don't know if you'd refer them as like the footnotes or just like the section that's outside of the income statement. But what I like to see is like the segment stuff. So yeah, like note P. Again, every stock, every 10K is going to look different, but here's where you can start to see like what makes up that revenue. And sometimes they do it for earnings too. So it looks like this company, they're doing it for sales and then operating profit. Can you guys see that? Sales, operating profit, and then like assets. So they're really dividing out the segments really, really nicely for us, so we can really understand you can start to go past the numbers if that's something you like to do. So, for example, I know Hormel, I'm a big fan of spam. Being half Filipino, that's kind of like a requirement. If you're any sort of the Pacific Islander, there's a good chance that you love spam. And it's funny being out in the East Coast now, meeting people who've never heard of spam, never tried spam. And to me, coming from California, that's where I grew up. That was just crazy to me. But, I know they do spam. They do like protein stuff. I think they do muscle milk. That's one of their things. Genio. Any West Coasters who like Del Taco, I know Genio had the turkey tacos. I don't know if they do that anymore. But when I left in like 2015, they were just ramping that up. But anyway, and then, obviously Hormel has just a ton of brands. I don't know if you guys are familiar with them. But, I mean, you just go to the grocery store and you're like, wow, this is Hormel all over the place. Yeah, so there's spam like I was talking about. Skippy, right? Applegate, I don't know what that is. GG. All this stuff. And so that can fall in these different segments: grocery products, refrigerated foods, turkey store, specialty foods. And so you can use the notes to the income statement to get a deeper look into what's really going on within the business, and you don't have to read through all 100 pages like what they kind of show to get that information. Remember, use this Control F, the search function. That's going to be your friend. And you can search for things like segments, or I'm sure you could do like notes to blah, blah, blah. Maybe because it's a statement of operations. I mean, yeah, there's just a ton of ways that you can kind of find that information. So I like to use segments. Usually most 10Ks will call it segments. And that's a way to kind of look further if you're looking at something that's like qualitative. I'll say I don't do that personally for my own investment thesis. I'm very, very quant based. I'm very value trap indicator, very deep into the numbers. But, I do like to occasionally do that just to craft an own story in my head, even though it's not impacting my decision at all. And I know a lot of value investors and people who check out my stuff aren't necessarily doing 100% exactly the same stuff I am. So I know that's going to be kind of helpful for you if you're looking at income statements. So that's going to wrap it up. Wow. 3 tutorials to cover the income statement. Obviously, a lot of material, but, a lot of intricacies, a lot of details with this stuff. Hopefully, I've kind of preemptively was able to prevent any sort of hiccups that might come up when you're starting to navigate through these 10Ks yourself. A couple different ways we tried to do that, and hopefully now you can look at an income statement and understand like, wow, okay, that's what this stuff means. This is how I can analyze it. This is how I can make it useful, and just kind of move on from there. So obviously the balance sheet and the cash flow statement is still to come. That's going to be tons of fun, and I'm sure I will expand over and over and on about those like I love to do. If you like this video, by the way, go ahead and leave a like. It will tell me what kind of content you guys are enjoying. That way I know in the future. Obviously, I'm going to continue this series all the way to the end, but in the future, I'll have, if there are likes on certain videos, and I'll know what kind of content people are enjoying and what kind of content I can think of to create more of that will be helpful for everybody out there. So as always, you're going to have 3 options from here. Number 1 is subscribe to the channel. Click on the bell to get notifications every time a new YouTube video goes live. We're doing Saturday videos for this 10K tutorial series. So definitely subscribe if you are interested in that. Option number 2, subscribe to the email list over at stockmarketpdf.com. You'll get a free ebook. You'll get daily tips. And it's just a helpful resource. And option number 3, definitely check out the playlist I created on the channel called How to Analyze a Stock with Valuations. It's a very, very helpful resource. And it should help you get on your way, kind of take the next step. Once you know how to get through a 10K, then you can take the next step and do some valuations. We kind of did a little bit here with the price earnings and the price of sales. But obviously there's more to it. And so that playlist should help you with that. Stop working for money. Put money to work for you. Thanks. I'll talk to you next time.